Tired of seeing your business plateau despite pouring countless hours and dollars into growth? In this video, I'll reveal two game-changing metrics I heard about from Alex Hormozi that can skyrocket your success, double your profits, and scale the growth of your business. Hey, what's up, guys? Welcome to the Data Boy Blog YouTube channel. First of all, who is Alex Hormozi? In case you haven't heard, Alex Hormozi is a popular content creator, author, and entrepreneur in the gym and fitness space who's known for his innovative business practices, and his book series that includes $100 million leads and $100 million offers. I've gotten a lot of value out of the information he shares, so I wasn't surprised when I learned something new from his YouTube videos on these topics, even though I already have an MBA degree and plenty of business and entrepreneurial experience myself. As a marketing consultant, I found these metrics helpful in identifying whether I'm solving the right problems for my clients. Sometimes we focus on getting more leads or traffic, but the real issues can sometimes lie deeper within their business and financial structure. So let's dive into two of the metrics that he says set successful businesses apart from those who are struggling to grow. The first metric is gross margin percent. Alex emphasizes aiming for an 80% gross margin. This metric is based on your revenue minus the cost of goods sold for products or the cost of fulfillment for services. By targeting an 80% gross margin, business owners can potentially double their take home pay when comparing, say, a 65% gross margin, because the take home pay could rise from, say, 12% to 25%. For me, this wasn't the typical marketing metric that I look at, but it's actually a business metric that can be fixed by either raising prices or cutting costs. Gross margin is a critical measure of a company's profitability. It reflects the percentage of total sales revenue that the company retains after incurring the direct costs associated with producing the goods and services that it sells. Alex also explains that by maintaining an 80% gross margin, businesses can significantly enhance their net income and overall financial health. The second metric is the LTGP to CAC ratio. That means the lifetime gross profit divided by the customer acquisition cost. This measures your business's scalability. If this ratio is less than 3, then Alex says it constrains your ability to scale. This metric highlights whether your business can grow and sustain itself long term. The LTGP to CAC ratio is a key indicator of the efficiency and effectiveness of a company's customer acquisition efforts. It ensures that every customer you acquire contributes significantly to the business's profitability over their lifetime. For example, if your LTGP is 900 and your CAC is 300, your ratio is 3, meaning you're efficiently converting your marketing spend into profitable customer relationships. However, if your LTGP is lower or your CAC is higher, this ratio decreases, indicating a potential issue with scalability. Basically, increasing this ratio helps ensure that every customer you have is profitable enough for you to then go out and afford to pay the cost to acquire more customers via marketing, advertising, content creation, sales staff, software, etc. So let's talk about a case study on applying these metrics. To illustrate the importance of these metrics, I want to share a recent case study. I made a proposal for a prospect whose gross margin was around 40%, which is far below the 80% target. His LTGP to CAC ratio is high, but he faces serious issues with high churn rates due to the high price of his services. Despite having excellent Google reviews, his high prices lead to a churn rate of 50%. He also doesn't spend any money on marketing, relying solely on the organic leads from his Google Maps and Google Business Profile reviews. This situation highlights the disconnect between the quality of his service and its pricing, which causes customers to leave after a short period, negatively impacting his lifetime value. His primary long-term problem isn't actually lead generation, but seems to be his high costs, which require him to charge high prices, which leads to high churn, since people can't afford his services for long. I think he needs to reduce his costs, which might involve reducing staff size or hours of operation. Additionally, he should focus on creating local content to attract more sustainable leads. He has a YouTube channel which has potential, but it's not targeting his local market effectively. Ads also haven't worked for him in the past when dealing with ad agencies. It became evident to me that his cost structure had room for improvement. For example, he could consider training clients himself to reduce the need for additional staff, or he could hire new staff members at a lower wage than his current staff members and train them to replace those more expensive staff members. Another potential solution could be to adjust his hours of operation to better match the peaks in foot traffic that I observed from his Google Maps data. By making these adjustments, he could lower his operating costs and allow for more competitive pricing that will help him reduce his churn. This could help him increase both his gross margins and his lifetime gross profit. Even though his gross margin percent was low, his LGTP to CAC ratio was actually very high in the multiple hundreds, which seemed counterintuitive. This was primarily because he wasn't investing in marketing, relying purely on organic leads from Google, specifically Google Maps. While not paying for customer acquisition might sound like an advantage, it actually limits his potential for growth and worsens his churn problem. He mentioned that ads never worked for him and he tried running ads with 5 different agencies, but they never successfully targeted his ideal customer. This makes sense given the high price point of his services and the small specific niche he targets. Finding those customers through ads is probably going to be very expensive. Although he didn't have any effective lead magnets to attract the right customers, he still was able to get leads through Google. But he also lacked content that would appeal to his local market. And even though he's been posting a video or two every week on YouTube, the content wasn't necessarily able to target his local customer base. My suggestion was he used his YouTube content to help sell info products online or affiliate products so that he can monetize his audience outside of his local customer base. Due to his high monthly expenses, which are probably about a third of his lifetime value per customer, he has a big problem there. So, for example, if the lifetime value of his customer was $1,000, but he spent $300 a month on expenses, it would quickly erode his profitability. This discrepancy between revenue and cost is a critical issue that needs addressing to ensure his long-term sustainability. These insights show how crucial it is for consultants to look beyond traditional marketing metrics. Fixing business problems like high costs and churn can significantly impact profitability and scalability. By using Alex Hormozi's metrics, we can identify deeper issues and develop more effective strategies for long-term success. What I like about these two metrics is that they act as guidelines to help us highlight where the actual business issues are. They go beyond the surface level problems of lead generation and dive into the core operational and financial aspects of the business. This holistic approach allows for more targeted and effective solutions. Why? Because if someone comes to you as a marketer and you solve their marketing problem, but they still have a deeper business problem, they're not necessarily going to be a satisfied customer at the end of the day, even though you gave them what they told you they wanted. In conclusion, understanding and applying these metrics can provide valuable insights into a business's health and potential for growth. They can identify areas where improvements can be made, whether it's through cost reduction, price adjustments, or better targeted marketing strategies. By addressing these foundational issues, businesses can achieve more sustainable and profitable growth. Thanks for watching. Let me know if you ever used these measures before and how they've impacted your business. Don't forget to like, comment, and subscribe for more insights. See you in the next video.